Okay, good afternoon, everyone. Good morning for those who are in US time, I believe, and evening for those who are more on the Asian side of the world. And welcome. Thank you so much for making the time for our new webinar, our new series by Digital Collective Africa. So my name is Dan Mabialas. I'm the head of program at Digital Collective Africa, and I'm really glad to have you here. And before we get into the good stuff, let us warm up a bit the room. So do me a favor, please. If you can drop a note on the chat and tell us where you're connecting from today, even a bit about your name, and then also your LinkedIn profile, like your LinkedIn URL. It's going to be a good way to connect digitally, right? And I know that some people from Lagos, Nairobi, Cape Town, Abidjan, or Paris are connecting. So wherever you are, you're really, really welcome. And just to follow, so what we have today, we have a lineup of things that we are going to present to you. And then from there, we're going to dive into a discussion on venture debt, which is really a hot topic nowadays, especially in the tech ecosystem. And we have a very good lineup of panelists that will be introduced just now, just a bit later. I'm just going to take about 10-15 minutes to present to you some great stuff and also our toolkit that we are just launching. And then from there, we're going to flow into the discussion. So just to start very briefly, first of all, about who we are before we dive into other topics in a short time. So what is DCA? So basically, we are a community, first of all, of African investor, incubator, accelerators, and founders who have come together with one shared goal to support early stage startups across the continent. So we work together on projects that limit friction and bring more transparency into the ecosystem because we believe that as the ecosystem is growing and it grows faster, we build together rather than being in silos. So that's really our aim. So right now, our community is composed of about 300 members, mainly composed of investors, but also incubators, accelerators, and some founders. And we also have a WhatsApp group, an open source website where we step by step bring into fruition the community and where we animate and we bring some tools such as the Venture Debt Toolkit that I'm going to have the occasion to present to you now. So concretely, what do we do? Just to give you really a breakdown. So we work across a few areas. So we facilitate early stage investment by standardizing the processes that usually slow deals down. So that's one of the aspects of what we're going to present today. So we work with VCs that build some tools and some, I would say, standard checklists and so on that then we disseminate to the community. We also have we open up access to market data. We build reports. We also help you to understand each country's regulations. We have some toolkits that speaks about that we presented earlier this year. It was, I think, 2 months ago where we had our first webinar on the incorporation toolkit. And we also have some education content, and then we contribute really bring inputs from startup and investors, and we share it across. So our working groups, the way the mechanism works on the DCA is that we have active work groups that works on different components, especially this year. So one of them is the incorporation playbook. We built a playbook to help you navigate where to incorporate as you're building your startup and growing it. We also have a governance toolkit that helps you out to set up your governance. And then we also have playbooks, especially for those who are interested in expanding or the investors that are interested in investing in Francophone Africa. We built some guides to navigate the ecosystems there. We did one for Senegal and one for Ivory Coast. And then we're still in the works for other playbooks. And then we build due diligence checklist. And today we're going to present to you a work that we have finished, the debt funding playbook. So everything we build live is on our platform. You can access it right now. It's available on digitalcollective.africa. And there you can find tons of things. You can find resources and so on. I will be able to present it to you just now. So two things that we have particularly worked on. The first one is open sources. where you'll have access to some repository and databases. And then the second one is resources, where you have then access to playbooks, where you have different components that can help you navigate different aspects of the ventures that you are building. And just as a last announcement before I dive into the toolkit itself, coming from Digital Collective Africa, we have announced earlier today via our newsletter on the Africa Arena, because we work alongside the Africa Arena component, our Venture and Conference 2026 that will happen in Cape Town. It happens annually. And for this edition, it will happen between the 27th to the 29th of November in Cape Town, in South Africa, alongside the the Investor Week that happens every year alongside Super Return every end of the year in December. The weather is great in Cape Town. I really encourage you to join us for the series of events that we're gonna have in Cape Town if you're still planning your business trip, and if you are based in South Africa. It's gonna be really an exciting week. You have a glimpse about the activities that we are going to run alongside the Grand Summit. So if you're interested, I will drop my information myself. So you can contact me, you can contact the team, and then we'll be able to give you more information about what's going to happen. So diving into quickly the Venture Debt Toolkit. So just to set you the scene, and as I'm going to speak, you can scan this QR code. First of all, it's available already online. If you go to our Digital Collective Africa website, you can go, as I'm going to explain, you can navigate it as well so that you can be practically also going through the toolkit. But to set really the scene, in 2025, venture debt on this continent, Africa, crossed $1.6 billion. That is about 41% of all startup capital raised in Africa. And that's nearly half of the money flowing into African startups last year. And it was not equity, it was a mix of equity and also debt. So it's really a vehicle that is more and more growing. And we felt the urge in our community to bring more tools to our community, to the African tech ecosystem, and then be able to disseminate some of the information so that how it works and then how to navigate it. So if you go through the tools, the first thing that we found is the first module. First of all, you have really a page that gives you general information about what it is, how it is disseminated into the market. And then when you start going through the tools, there is about 14 modules. The first modules gives you access to why actually, as a founder, you would consider a debt. So the first module is named as, it works through the real trade-off between raising more equity and taking on debt, what each one actually should actually cost you in ownership. We're going to discuss that during the panel. And it's really designed to help you to ask the right question before you even talk to a potential debt funder. Is it the right moment to raise equity, or is it the right moment to raise debt? And is it also the right moment to mix both? So that's the first module, what it covers. Then after that, on the third module, what it does is it gives you the mechanics module. So it is where a lot of founders finally have their data moment, and where we break down how venture debt actually works in the African context. So what the interest rates really are, the reality checks, and we explain equity warrant, arrangement fees, and so on. You really start to have more and more information about really how it works. And then on the next module, so the module on understanding the revenue-based financing, now we go more in depth, and then we start to give information about how it works. So instead of fixed, how it works in terms of revenue-based financing. So instead of fixed monthly repayment, you repay as a share of your revenue using what is called a capital factor. So we explain all these aspects of the different mechanism of venture that goes along the venture debt. And then we also have modules that cover hybrid structure, the creative combination of debt and equity that experienced founders and lenders use to balance cost, risk, and dilution. We go also on a different modules such as different decision framework, where we get practical now. So this module gives you the tools to actually decide. So it's a decision framework to help you choose the right instrument for your situation. So there are questions that are set up, and then based on the answers that you will get, then this tool will give you some guidelines about which decisions you need to make. Then something that is also very interesting that I really wanted to highlight is the lender. We have a lender directory, so where you will have access to a directory of verified, active venture debt and revenue-based finance providers across Africa that are categorized by types, geographies, sectors, institutional lenders, DFIs, and impact funds. So that's really where you kind of have the bread and butter when it comes to information that you would need to navigate who you can speak to, you can make some research, and so on and so forth. And then the last module that I really also wanted to bring forth is our case studies. So in terms of venture debt, you really want to see what has worked and how it has worked. So on this module, you will see case studies of startups that have raised debt funding and where it has really brought them to the next level of their ventures. So you have different type of examples that we dive into, and then why it worked, what the founders learned. It has been brought by the collective in terms of examples. So it's going to be also a great part of the tool that you can use to navigate your understanding for debt funding. So there is more. I'm not going to dive to everything. I really tried to brush through as fast as I could to really give you a glimpse about what it covers. But I really invite you, as the conversation is starting, as the panel also is going, to go through the tools and explore what it covers and how it can help you to decide if you would raise a debt or not. But without any further ado, because I'm not the star of the show today, I'm going to call on stage and in front. I'm just going to disappear now. Jacqueline, managing partner of Igazi Tech, based in Kenya, Nairobi. She's going to present a bit more about herself, but also about the panelists that will introduce the discussion. So Jacqueline, over to you. I'm just going to stop sharing my screen and you can take us through the discussion. Welcome.
Thank you, Dan, and good afternoon, everyone. It's my pleasure to be joining you all today. And thank you, Dan, and the Digital Collective Africa team for this opportunity to have to engage in such an important discussion as it concerns funding options for African startups. So my name is Jacqueline Iminza Anyamba. I'm the co-founder and managing partner for Igazi Tech. We are an business advisory firm and a venture building platform, working with early stage to growth stage startups to provide tailored advisory support as well as hands-on venture building support. And our mission really is to bridge the gap between strategy and execution while helping founders access capital and resources for growth. So our goal is to be a driving force behind a thriving African innovation ecosystem. I'm glad to be here today, and allow me to quickly introduce our panel of experts who are joining us for this discussion. And even as I introduce the panelists, I'd like to just encourage the audience to feel free and engage with us through the chat box. I don't know if that's open to the audience. Let us know where you're dialing in from, whether you're a founder, an investor, just to see how many of us are founders, investors, to also help our panelists to know how to respond to different questions. And along the way, during the discussion, we'll also encourage engagement from the audience. So get your questions ready, your reflections, and if you wish to share with us as well. And so to start with, I'm going to introduce Akash Maharaj, who's the managing partner for I Am Capital Advisory, as well as general partner, Newton Partners. And Akash brings 2 decades of structured finance and a front row view of how institutional capital reaches African companies. Akash, you can just wave for the audience to see you. I'll give you time to speak as you get into the questions. Next, we have Lou Chopera from Africa Deal Flow, who's the lead at Africa Deal Flow Catapult Ocean. Lou has spent over 20 years on the investor side of the table, from venture capital to impact and deal flow across the continent. And yeah, there you go. We can see Lou over there. You'll be hearing from her shortly. We also have Nick Rohani, who's the CEO and co-founder of Vula. And Nick sees the funding market from the inside, powering systems that lenders, DFIs, and VCs across Africa use to deploy capital. I promise you that I've just shortened the profiles of these speakers, but they do have quite a detailed level of experience, and I'll allow them to speak to it as we get into the questions. And I know we also have limited time, so we'll try and make the most of it. And just to get us started, I know we've spoken about venture debt. If you've been keeping up with the tech news, we've seen how the shift is happening in the ecosystem, and more recently, where we've had an explosion actually of venture debt in the African startup ecosystem. There's a massive debt surge where we are looking at roughly 1.6 billion to 1.8 billion, which nearly doubles previous cycles, which has been invested into African startups in form of debt. There's quite interesting statistics around that in terms of the geographical hubs, the concentration, with Kenya emerging as one of the powerhouse for debt financing. And so we are going to be understanding the why behind that in terms of the sectors of focus as well, if you look at it. But really the question here is, what exactly is causing this surge of debt, and why are founders, more importantly, looking at other options, alternative sources of funding? And what is important to note is that even as we consider debt and even as we gain access to debt, it's not really coming to replace equity, but we are going to be unpacking how to strategically leverage debt for catalytic growth, even as you complement it with equity funding. And so I'll start with Akash to get us started. If anyone in the audience is wondering, what is venture debt? What do we mean by venture debt? And so maybe Akash, over to you in simple terms, just to tell us what venture debt is. How is this different from traditional bank loans or equity? And at what point does debt really make sense for a startup?
Thanks, Jacqueline. Yeah, so I think the interesting thing is, what is the definition of venture debt? And if you look it up, it's any debt to a venture-backed company. So pretty wide in terms of the definition. But I think the way I've always thought about it is, banks, which I spent 25 years in banking, so forgive me, guys, but I look at banks as really financing your past and pricing the debts based on your history, whereas I think the venture debt providers are really looking at something beyond that, which I'll get into now. In terms of banks versus venture lenders, I think banks are looking at your cash flow, your collateral, your audited track record, right? They can't lend to something that's loss-making technically, so they really are kind of out of that market. They have been traditionally, but there have been moves increasingly towards the space from the bank side, driven by the fact that these businesses grow so quickly and often hit the metrics that the banks would lend to, and the banks want to be at the table in that case and building those relationships earlier. But largely, it's almost loans for companies banks won't touch yet, is the way to think about it. The venture debt lenders, on the other hand, they underwrite your equity round. They underwrite the investors behind you, your runway, and where you're going, your trajectory. In terms of you putting it up against equity, the often quoted line is it's non-dilutive. I don't think that's entirely accurate. There is some dilution you get from the warrants, but I'll talk to you in a bit about what that is in comparison to your dilution from a pure equity round, and it's minute. but it must be repaid. It comes with covenants, and think of it as renting capital instead of kind of selling ownership of your business, right? As a differentiator. I often think, kind of equity buys you that journey, gets you on the road, and then debt is kind of extending your runway between milestones on that journey.
Thank you, Akash. And a very good point you've raised there that a lot of us, I think there's a blanket assumption or mental note that debt is non-dilutive entirely. And so we'll be looking back to hear from you on that specific point. But just quickly to hear from Nick as well, in terms of what you see from across the market, how well do founders actually understand debt as an alternative option for funding?
Not well at all is the quick one of it, Jacqueline. I think generally what we find across the ecosystem is, as Akash has said, our traditional financial institutions are not playing the games that we need them to play right now, and so everybody's trying to figure out answers. But what this also means is that we can end up with deal terms that seem quite complex, with covenants or warrants or conditions precedent, which funders need to put in place to protect themselves, but which can also create a little bit of suspicion or misunderstanding from the point of view of founders. And so we need to find a way to kind of speak each other's language and to start simplifying some of these. But I also think, and what we've found is that as more venture debt gets deployed into the market, founders talk to one another, and the positive experiences that they're having with engaging with funders on the debt side is translating into more engagement with debt funders. And as Vula, we're very happy to see this, because the more creativity we can get in the funding instruments we offer to the continent, and the less we sort of emulate what we're seeing from the outside world, the more we see real value being created. So it all comes down to simplification and making some of these terms more accessible to founders.
I really agree with you on that. And you've mentioned covenants and warrants, and perhaps for a founder who's in the call and they have no idea what that really means, do you want to just tell us maybe in a minute, just to simplify it and
For sure.
That we need to speak same language?
Look, in the end, and I've got many more experts, people with more expertise than this than me on this. But in the end, a covenant is a promise. Any funder who is backing you for some risk that they're going to be taking. And the question is, how are they controlling that risk? So what we need to do when we make agreements with each other is to really set what the conditions are under which you'll be paying back, under which potentially our debt gets, as Akash was mentioning, can sometimes get converted into equity. So if you're not paying me back my cash, then I need to get some portion of your future earnings as equity, for instance. In the end, what covenants are contractual protections for funders to say, when this happens, then you owe this. If you're able to cover your cash flow up until this point, then your equity is safe. And in that case, we really like it because it allows businesses to perform. And if the performance goes well, then the deal can follow. And if the performance doesn't go well, then the funder has the protection that they need to ensure that they're not taking too much risk.
Thank you, Nick. I can see Lou nodding as you speak, and maybe just to invite your perspective on this, and especially as an investor, to hear from you in terms of at what point would you want a founder, especially in your portfolio, having this background and understanding, to consider debt alongside equity? And what are some of the misconceptions from experience that you've come across founders have toward debt?
Okay, thanks, Jacqueline. Yeah, so I work as the deal flow lead for Catapult Ocean. We're an ocean-focused fund with a very narrow mandate, but our mandate does sit at the intersection of climate, ocean health, and also impact investment. We are still focused on early stage businesses, but some of our global portfolio does extend up to Series B. I spend most of my time sourcing deal flow on the continent for Catapult Ocean, but I'm mostly working on really supporting a very early vertical in climate as it relates to blue. So the rise of venture debt is especially exciting for us from a climate perspective, because if you look at the breakdown of that 40 to 46% that was referred to earlier, most of it actually is concentrated on a few deals from 2025. And so these climate ventures in particular have certain characteristics that make it a good alternative or a good complement to equity. So what I'm getting at for founders especially, and what we need to understand is debt is not a one size fits all. There are particular opportunities where debt makes sense, and there are some where it can ultimately actually become dangerous. And that's when we come in from the perspective of when is the right time, also when is it as an instrument the right capital stack for a startup, for an early stage business, especially. And so for founders, my advice is always to look for the kind of characteristics that will allow you to repay that debt. So whereas general equity speaks to innovation and R&D because there isn't an expectation of repayment, debt does speak to the need to have enough cash flows that allow you to repay on time and that allow you to honor all the covenants around the agreements around that funding structure. So you do need to have a business where the cash flows and the revenues and sales cycles are predictable. That's the first thing. That's why when you look and the second layer of that 46% of debt that went into VC, it went to cash generative businesses that have predictable revenues. So that's really important for a startup founder to understand. And over and above predictable revenues, you also need to have good governance structures in place to allow you to make sure that you have the discipline to pay and to honor the covenants of that. And so cash flow management will be important, even in terms of having, on your human resources, a strong CFO is quite important for you to be able to attract debt onto your book. But it is a good alternative to equity because in a sense, it's less dilutive or non-dilutive in some instances compared to equity. In climate, we also have grants, but grants are supposed to just take you to a certain point of your journey before when you're pre-revenue. So if you're pre-revenue, debt is not for you, I would say. You need to have predictable revenues. You need to have a clearer pathway to profitability for it to make sense. And when does debt not make sense? It's the opposite of that. When you have maybe seasonality in your cash flows, when you have unpredictable revenues, then it might not be the best option for you. And where it becomes especially dangerous is when businesses take on debt for survival. So you do have a funding gap and you becoming desperate for cash flows, and then you approach debt providers for that. That can actually become dangerous for your business. So that's what I would say to founders, that just understand that debt is good for certain very specific types of businesses. And where we would call it good debt is when you're using it for maybe asset-backed finance, where you're using it for specific funding needs of the business. But it's not just a one size fits all.
Thank you for that. And maybe just to double down on a point that you mentioned, which I think is quite critical for every founder to understand. And you've spoken about having the discipline to pay. So perhaps a question that most founders have in mind is what does it really mean? And especially practically when you look at our African markets that come with a lot of FX issues, what are the practical risk and cost realities for debt repayment from your perspective, Blue?
Yeah, I think when I think about it, the discipline and governance comes in with, fundraising is not easy for a lot of founders. And when they finally access finance, especially in climate now in Africa, where there's a lot of access to grants, there's sort of a relief that comes, across the team when you finally secure that funding that you've been trying to raise. And where it becomes dangerous sometimes is startups then adjust their spend according to the specific round that they have closed. So if it's grant funding, you suddenly pick up 250K to 500,000, and there's this relief that comes. And if you've got co-founders, you probably the discussion is now we can actually pay ourselves more salaries, right? And then so that becomes now your threshold for your expenses, that you are more relaxed around your spend, whether it's for marketing or for go-to-market strategy or whatever you've been trying to fund. But then if you run out of runway before you secure your next round of equity, then that's when most founders start scurrying around for a plug. And that's when you are almost raising from your back foot, and you don't ever want to do that. So when we talk about financial discipline, that's what I'm referring to actually say you always want to give yourself an extended runway. So if you close a round or if you do secure grant funding, you want to remain disciplined around what you spend it on and what you prioritize, just to make sure you give yourself enough of a runway to get to your next round. But you also want to be, make sure that you get your priorities right in what you are using the funding for, whether it's equity, whether it's grant funding, even with debt. You want to make sure you're using it for the right reason. And I always say, especially with debt, you want to make sure that debt will help you, whilst equity you might use it for R&D, debt should, accelerate your growth more than anything. And so it should be used for revenue generative activities, especially.
Yeah, totally makes sense, especially if you're taking on foreign currency debt and you're generating your revenues in local currency, then you need to be very careful around your costs and your expenditure and how best you're using this funding to strategically catalyze your growth. Coming back to Akash, I know you alluded briefly to the nature of debt in terms of it being dilutive or non-dilutive. So maybe I can just come back to you perhaps to hear your thoughts on the nature of debt, and perhaps while at it, tell us a little bit more about when a founder should think about giving up the cost of debt versus giving up equity. You're on mute.
I think I should know better by now. Yeah, look, I think Lou's articulated the where does it make sense quite well. I just think you definitely don't want to raise venture debt instead of an equity round. You want to complement your equity round with it. So you want to have your equity investors come in, and you want to make sure that you are augmenting that round with a bit of venture debt if possible. And definitely predictability, assets against your lending or your borrowing, and it's receivables, inventory, fleet, hardware. If you look across Africa, those are the kind of deals that got done, and those are the sectors. Fintech, climate tech, and mobility, I think are the particular ones that lend themselves to it. The cost of debt versus cost of equity. I mean, this is one where I've had numerous debates, and I think what hits me is founders don't often understand the cost of equity. To be honest, and maybe just like a simple kind of math here. If you give up kind of, let's say, 15% at let's say a $10 million valuation, right? That looks okay, 15%, what's that? If you go on and build a $100 million business, that's a $15 million cost, right? For your free equity. So that's kind of simple math. Now, in comparison, if you go and raise debt, let's say a $2 million facility, you're pricing at a 15% coupon and warrants, it's insignificant, right? The amount of coupon and the pricing, even with the warrant baked in, it's insignificant in comparison, right, to the $15 million. So that's that, and so you really got to think about pricing your equity at your exit valuation, right? Think about the business you're building and how much of it you're giving away, and the valuation you could hit, right? And I mean, look, everybody wants to build a unicorn, $1 billion business, but even if you're realistic, right? If you give away 10% at a $50 million or $100 million business, it's a whack of cash, right? That you're effectively giving away. So if you want to look at just pricing, most venture debt across Europe, across the US, they kind of price it between 15 to 20% all in, right? That's coupon much lower, 10 to 15%. And then you've got your equity kicker baked into it, right? The equity kicker, is something I don't think founders understand. I don't think many market participants understand. It is really about the value you're building in the business and giving your debt provider an appropriate return for the risk they've taken. For the fact that your business, when they went in, was often pre-profit, often even pre-EBITDA break even. And so they're taking a risk that debt generally doesn't take, banks don't take. So you're giving them participation in your business, right? And that warrant often gets more expensive the more successful your business is, right? And it's a weird thing if you think about it. You're almost paying back more the more your business grows in valuation, right? And so often, are you incentivized to build a business? Yes, you are, right? Because the venture debt provider is coming in and providing that at a time when they take in ordinary amount of risk for where the business is, so they have a right to participate in that upside. And that's that's often where this breaks down in the debates between and we've lost deals, right? I think I spoke to a venture debt provider in Europe lately, and they were saying to me they do 4 term sheets for every one that gets accepted and a deal that closes, right? So it often breaks down when they look through the term sheet, they look at the costs, and they understand, geez, like, what is a warrant? What does that mean? I've had so many of those debates, and those often break down at a deal closing stage. So I think that's how to think about the costs of debt and equity.
Sorry to jump in here, Akash, but I just wanted to say that we're actually seeing very similar proportions on Vula as well. It's about 2/3 of actual said term sheets, and 1/3 of them actually get taken.
I mean, and I think it is because once you get past that term sheet stage, the reality of what they're signing hits. And I think the two things actually happen, right? The founders look through it, and there's lots of terms there which, to be honest, aren't as simple as they should be. I think you made the point earlier, Nick. But I think the second important thing is founders often then have to go to their current investors and sell it, right? And they're going, well, hold on, this is all great while we're negotiating, but now I've got to get my sign off from investors, I've got to get everybody else on board, and I don't understand this thing that's been put in front of me, right? And so I think that's where it also breaks down. I think the last thing I'd say is the real cost of debt is actually in the fact that it's not flexible, right? Equity is patient and forgiving, right? I've been an equity investor for many, many years. I spent the majority of my career in equity investing. And once you're in, right? It's very hard to get out. On the debt side, once you're in, you actually have a whole bunch of ways of getting out, right? But it leads to a very inflexible structure where and I think talks to Lou's point from earlier, where the founding team has a very rigid kind of process, right? They have to report, they have to pay back on very specific timelines. And if they aren't mature as a business, they don't have maturity in governance structures, they don't have maturity in the CFO, that's where it breaks down. So venture debt providers are often looking for that. They're looking for mature teams, right? And guys who kind of understand what they're getting into. So yeah, I would say cheap, but it's got a lot of little hidden things to watch for that you need to understand about it. And it definitely has its place.
Yeah, I just want to push back a little bit about the one-on-one on 15 million. 15% means 15 million, because I think the whole idea of scale and more capital from an ownership perspective is two-pronged. Now I'm selling VC, you know, the first one being there's more alignment if we own something of the business together. So we all lose together. So there is more alignment compared to when they are debt providers, because they sit higher in terms of if the business gets into liquidation, and like you're saying, in terms of the covenants around the debt arrangement, most founders, get a shock as to actually what's written in when something goes wrong. The risk profiles are different for, owners and equity owners to debt providers. And Jacqueline, you touched on it a little bit around the Forex risk around debt. It's real. There was a hotel that we invested in, which had debt, a lot of venture debt in essence on the book. And the challenge with debt or even revenue-based finance is that they take the repayments on the top line, right, on the revenue, regardless of what else is going on with the business. And sometimes that's the challenge around venture debt. So you need to be very careful and have a good understanding of what you are signing up for when you take it on. So that's why you always say it's not a one size fits all. It's not for everyone. You need to actually make sure you're in a good, strong position to pay back in terms of your cash flows. Whereas, yes, like Akash said, equity is more forgiving in that everybody loses. Whereas with the banks, they're going to come, you're going to renegotiate things, and they will charge you establishment fee. It gets expensive to try and renegotiate. They don't care about the Forex exposure. If it's a dollar-based transaction, especially across Africa, that also in itself may make it challenging even for cash-generative businesses such as hotels to repay that debt. So you need to really be careful and make sure you understand all those nuances around the instrument that you opt for.
Actually, I'd love to build on this point if I could, because I think, Jacqueline, on the FX question that you asked, there's kind of a dual responsibility. And sometimes we see founders who are, they're in the market for some sort of financing, almost treat the currency underlying a deal as a secondary consideration. But the reality is that if you have a US denominated debt note from a provider. And we've seen this happen to a couple of businesses where, I'm working in Naira. My working capital is in Naira. I'm paying my employees in Naira. I get my US-based loan. My repayments are based in US dollars as well. And even though my business is growing, 30, 40% quarterly, which is amazing, because of my FX slippage, I'm actually falling behind on my debt payments. So I've got a successful business. I'm utilizing this capital the way that it should have been utilized. My plan is going according to plan, but the macroeconomics are not supporting me. And therefore, according to the contract on that debt, I'm falling behind and I'm getting stuck. And what I wanted to say is that venture debt providers, or just debt providers as a whole, who have a mandate not just to be commercially successful, but who actually care about the ecosystem that they're supporting, actually have a responsibility here, in our opinion, which is that as the debt provider, you're in a much better position to be accessing hedging facilities and insurance on that than the individual business is in terms of their capabilities. And giving your portfolio companies the option to take a little bit more expensive debt, where they know that they have that FX coverage, is a huge service to this ecosystem, especially for markets, outside of South Africa, especially where we're seeing a lot more FX slippage. It's a huge bolstering to the ecosystem and enables these entrepreneurs to thrive.
Thanks so much, Nick, for that. And it's a good point that you brought about around hedging, and perhaps just to understand from an investor's perspective, because there has to also be an incentive on both the founder's side and the investor's side for this to work. And when it comes to hedging especially, are there any creative instruments that you've experienced that do facilitate these, and what does that mean from a cost perspective?
Yeah, I think there are warrants and guarantees around debt structures, especially from, I would say, impact funders, especially. They put those in place. But what's frustrating for me sometimes is when they're working with local banks, the local banks, first of all, their pricing around that does not reflect the guarantee behind it, which means it puts a lot of pressure on cash flows for the beneficiaries of that. So I guess it's for us as a VC, we tend to want to also have relationships with these financial providers to make sure that they are honoring some of the covenants from the perspective of their warranties and their guarantees, and therefore it should dilute some of the risks, and it should be reflective that should be reflected in the pricing. So that's some of the things that we see in the market that we need to be careful about. And we also just in climate, I think more and more, what's encouraging for me is we're starting to work in collaboration. So if I'm a VC, I'm not just I'm going along the fundraising journey with the founder. I'm not just investing and letting go and letting the founder figure out, the next round alone. Part of my value creation and value addition is to make sure that I'm introducing them to the right whether it's financial providers of debt, and I make sure I'm part of that negotiation process, and I make sure I'm helping them and supporting them in accessing grants when they need to, when they can. And I'm making sure that, especially around impact for mission-driven businesses, we want to make sure that the impact story is also coming out, because all that helps the founder to have access to more options in terms of accessing funding, and the capital stack in itself, for it to be optimal. The providers of capital shouldn't work in isolation, and more we're starting to see that as a trend, especially in climate. ventures where people actually work together and coordinate the capital structure in a way that will make sure that the pricing also does not squeeze too much in terms of repayment and cash flows out of the business. But the frustrating thing in Africa around, first of all, for me, there should be policies protecting founders around forex denominated debt, especially, and then around pricing as well, from a policy perspective. Because if a founder is desperate, sometimes they just go and access that debt, and with the hope and prayer that they'll generate enough revenues to cover that. But there should be policies around managing that and protecting founders a little bit. And we're starting to see better conversation. And I think forums such as this and Digital Collective Africa, we're all talking and speaking around just, making sure that we are building an ecosystem together and we are helping each other to come up with structures that actually, make sure that everything is done in a healthy way for everyone and in a fair way, not in an extractive way.
Thank you, Lou, for touching on that point. And I think especially when it comes, I can see there was also a question in regard to that in terms of the trends when it comes to FX forex challenges in terms of deployment of local currency versus foreign currency. And perhaps the question is what you're seeing as it relates to the conversations around the more push toward local currency debt and its impact to the ecosystem. But before you, and I'm going to throw that to anyone of the speakers who want to take it up. And as you do that, I'm going to be coming back to the audience as well. I think it will be very important if there's anyone in the audience who's a founder and to the extent that you can share with us your experience in terms of if you've raised debt, why you did it, and the whole process, how it has been for you, just a bit of reflections for that. So please feel free to put your hand up and we will take your reflections as well. But yeah, in the meantime, in terms of the push toward local currency debt to any of the panelists to speak to.
Look, I think, I mean, look, it is a silver bullet, right? If you can get local currency debt, take it. You just don't want to carry that FX exposure. So, I think there's definitely a push towards this. We've tried to think through solutions for the FX problem, right? And I think in our minds, tokenization over time is going to solve for this. It's a whole new world out there in terms of financial markets, and I think the key problem in Africa is you can get your money in. How do you get your money out, right? And that's where the FX problem often rears its ugly head. And we believe that over time, as more stable coins are issued, as tokenization is accepted, that's going to be the real silver bullet solution for this problem. It doesn't completely solve it. It mitigates a significant portion of it. I think the reality is, as you saw in Nigeria, when I was a Standard Bank, we were struggling to get dollars out of Nigeria a couple of years ago. That seems to have corrected somewhat now, but the inability to get hard currency when you need it to pay back loans is actually a big part of that problem. Never mind being in the local currency over a period of time. Last comment I'd make on this is, when we compare local currency funding against the foreign currency with a hedge, right? Because that's really what you're comparing. And you often notice the pricing is still in local currency quite expensive, which is shocking, right? And either if you just think about it, the local institutions are mispricing that debt, often because the business themselves are at a stage of development that they just don't understand and don't get, or is it just to be honest, mispricing because they can make a bit of money, right? And so they pulling the ringer. But I think that's the key. I think insight we've had trying to price that differential.
Yeah, I think. Sorry, Jacqueline. Yeah, just quickly, just to expand on your point, Akesh, I think what it is, it's opportunistic, right? Like Mekhe. So it's always that. If I can get away with it, why not? But then for me, it's very short term. It's not ecosystem building. It's very short term thinking because you are killing the goose in the process, and it's especially frustrating where it's local developmental institutions that are instituting the high pricing. But I think in terms of just conversations around that, we are seeing more meaningful conversations around that, and so we're seeing Digital Collective Africa at the last unconference. There was a lot of talk, even from LP perspective, because it comes from the mandate, even from the banks, right? I'm not just lending money. I'm lending money from, there's a mandate around how I manage that money. And there's confusion for founders, especially why they don't understand why VCs don't lend money. That they can. There's also mandates around VCs, specific to every VC. And that's dictated by the DFI or the other LPs that put money in that VC. So that's why sometimes it's an ecosystem discussion where you like, what do we want to see 5 years from now, 10 years from now? Because if we look at venture debt, it was at 4% 10 years ago. In around 2019, it was very low. There's a reason why it's coming up, and there's a reason why it makes sense now. We have more data points. But if we want to build something, it's really thinking of it as a system, right? Now there's a lot of talk around systems change and systems investing, and that requires everyone who's a player and who's a stakeholder to come and actually think in terms of a whole system, and not just their mandates, and to push back from their funders wherever they are, whilst VC are also pushing LPs to change their expectations so that we match the needs on the ground. It's happening now, and the discussions are around what we're doing now. So that's been encouraging for me.
Thank you, Lou, on that. And perhaps just something else to think about, and maybe I can invite Nick to share your perspective on this. When you talk about venture debt as an alternative source of funding, there's also other tools and instruments. You're looking at grants, you're looking at revenue-based financing. So tell us, where does debt actually sit when it comes to the capital stack?
Nice, yeah. So, at Vula, part of what we're doing is we're building a basis of infrastructure, because the truth is that the answer to your question is in the eye of the beholder. We've got an ecosystem where historically, for instance, when we're talking to entrepreneurs, we speak about investor readiness as though it's a single finish line that people need to cross. As though now, before you weren't investor ready and now you are investor ready. But the truth is that, like beauty, investor readiness is in the eye of the beholder. But it is extremely complex to ask the question for each business what their own unique capital stack needs to look like. Because each business is different. Each business's cash flow and cash conversion cycles look different. Each business's growth and scaling story is going to look different. And so the truth is, Jacqueline, that the answer depends on the individual business that we're speaking about. Generally, what we're asking is, what is the downside protection that I have on my investment into this business? What concrete assets are there for me to recover value as an investor if I look into this business? As Akesh was pointing out, equity can be seen to be quite expensive in that case if your business is going to scale up quite a lot. the end dollar value of what you're giving up as a business is huge. So when we look at debt, what we're really saying is that the investor has a limited upside because they can't make more than the coupon, than the interest rate on the debt that they charge you. But their downside is also protected because if you go down, you still have to pay back the debt. You don't get to just say, oh, I'm out of it, neither of us make it. So their upside is protected and their downside is also protected. From an entrepreneur's point of view, then, what that means is that you're going to have an obligation to this funder independent of whether the market is up or down or sideways. Now, I saw that Grace in the chat asked a question about some real experiences that we've seen at Vula, in facilitating these connections between funders and SMEs and startups, about how debt gets restructured when things don't go well, which in an African context is a lot, which is part of why Akash was mentioning even local debt providers misprice. Part of it is that they're gouging, and part of it is just that they're worried because their non-performing loans on their books are so high that they're charging your business higher because you're actually paying for somebody else's defaults. What we actually see is that debt providers want to work with businesses even when they're not able to pay because they see some opportunities. They see opportunities for the businesses to recover. They see some opportunities for them to get their money back. But unfortunately, sometimes even the debt provider's hands are tied. And so, we've seen the unfortunate circumstances of really well-performing businesses who default repeatedly on loans and whose own assets have to be liquidated just in order for them to pay back. This is a working business that's got real assets that are producing value. But unfortunately, in the end, the loan guarantee has to be recalled and somebody has to pay. And on the other side, we see funders who have enough coverage, who have enough kind of smart setups in terms of their own fund for guarantees and in terms of the amount of time that they can take, where milestones and warranties can be adjusted as part of the agreement, where the businesses can really be engaged with in open and honest conversation about where can we continue to unlock value and support you. But it's not that easy. I think another thing that we're seeing more of that we're actually quite happy about is distressed assets passing from banks that historically aren't the best supporters of a business that's in a tough situation and who usually just liquidate businesses to get their money back, being passed out to private credit specialists who can actually help those businesses recover and go out of a distressed situation. So you might have a really successful business, you are able to take a loan from a bank, things good, you get a downturn, maybe you're an agribusiness and there was a disease. You can actually be passed out of the debt book of the bank onto a private credit provider who takes a little bit of that extra risk, as Akash says, takes a warrant, which means they have a right to some of your equity if things go well. Sometimes it's called an equity kicker. And that incentivizes them to work with you to get this business back on its feet. And we've seen quite a few success stories like that from the likes of, for instance, Vula partners like TLG Capital, who are really good at running these types of deals and helping businesses get back on their feet. So I think in the end, what that means then is that debt is an instrument which in an African context, we have to take seriously. Many even of our startups, because they have to be camels, not unicorns, have a dual business operational approach where they have working capital needs for the core business that is generating revenue in the short term, while they can sell equity for that long-term vision of where this business is going to go, right? We have loads of businesses that are like that in Africa because unlike the US or unlike the UK, you can't just sell a dream. You have to have your feet on the ground and your head in the sky. And so venture debt covers the feet on the ground and equity covers the head in the sky. And it's all about finding that right balance. The last thing that I want to say that I think we haven't really touched about the reality of venture debt in an African context is that venture debt also exists to enable even successful startups who have raised correctly from VCs in the past to weather the storms of VC winters, which hit Africa all the time. Because as Lou mentioned, it depends on the DFI, it depends on the mandate, it depends on the trend for this 18-month period. And what we find sometimes is even the VC funds themselves don't have active funds to be able to deploy, to be able to continue to support their own portfolio companies. So I might have gotten, a great seed round. It's now been 18 months or 2 years. I happen to find myself in a VC winter for Africa, even though my business is doing pretty well. Venture debt can also work really well in this type of a situation to basically bridge that winter, give my company the working capital it needs, take some of that kind of equity risk. Let's say it's a warrant for 1 or 2%, where my venture debt provider does have that option to purchase some of my future equity. But it helps me because nobody is giving me any equity right now, even though I'm a successful African company. And we've seen that from a lot of founders too. So it's all about knowing the tools in your toolbox. And as Akash said, it's also about us as funders simplifying the way we describe this to some of the founders so they know those tools and are able to leverage them properly.
Yeah, and there's someone and who's asking about flexibility around debt, venture debt for founders. And I think around that, what I would say is from the time you are doing your financial model, there needs to be flexibility built into your scenarios. So instead of borrowing against your best case scenario or even your best case scenario, it's important to also make sure you're stress testing your model, right? And doing scenarios where you go, what if this doesn't go as planned? And it never goes as planned. So you need to ensure that you are also, modeling in some scenarios where things might not go as planned, as happens with business. What if, you need an extended runway by an additional 6 to 12 months? What's going to happen to your cash flow? So we found that there's a lot of success with founders that have the discipline to scenario plan around their strategies, like what happens if we don't sell, what happens if we lose a key client, what happens in this scenario, what do we adjust? And if you're that team that is savvy enough to have the scenarios already figured out, then you know what lever to deploy if something doesn't go as planned. But if you're sort of reactive all the time, then you would definitely get into trouble with debt. And I think even the banks, Akash, maybe you want to add to this. When you are looking at, deploying, you're not just you look at everything. You're looking at the team. You're looking, at the forecast as well, and making sure that, the chances of repayment are at least guaranteed to a level, because banks are not into, fire selling assets, right? That's not what they do. So ideally, you should scenario plan around best case and worst case scenarios.
Flexibility is what I can hear coming from both of you. And I really like the point where Nick talked about weathering the storm. And perhaps for those who are wondering in terms of how does it work in practice, especially where you're considering debt as a way to probably extend your runway as you position yourself for an equity round later. Are there any considerations in terms of a grace period? How does the repayment look like? And also just to hear a little bit from your own lived experience in terms of, are there, especially for the founders who are considering debt, are there standard practice in terms of the interest rates or standard market rates applicable?
Yeah, I'm happy to give you my perspectives on this. I think scrutinize those term sheets. I think start with the default section rather than the interest rate, to be honest. But I think there maybe 4 or 5 key clauses I would suggest you look at, right? It's obviously the costs, and the costs actually consist of 4 subparts, right? It's the coupon, the fees, the warrants, and the prepayment penalties, which often get overlooked in the initial review. Covenants, focusing on the MAC clause, minimum cash requirements, often very, very important, especially if you're early stage and kind of, these things take a while to close, so that minimum cash can change between initial engagement and when you're finally looking to close out or even sign full docs. I would look at the security package, right? No personal guarantees, or if guys are asking for personal guarantees, I think be cautious, if not run a mile. And then repayment profiles. These often have interest-only periods and then a repayment an amortization schedule. Those often. I'll come back to this point now in terms of how those are structured. The last thing I'd say is the currency mismatch, right? Which we talked on for a bit there. Just the repayment profile. I think Lou was talking about the flexibility and the how these things are structured. I think bottom line is nobody wants, your venture debt provider does not want the debt to default, right? So when you're setting it up, they're often looking to give you the flexibility around how your business is going to grow. They want the business to not have to go trigger covenants and have sleepless nights as you wonder, are you going to get your money back from a lender perspective. So this is often a very cooperative period where you're working with the venture debt provider rather than against them. You're working with your venture capital providers as well, and you're bringing them into the conversation. If you don't make this cooperative at the start, and I've seen it go wrong, I've been in deals where you've done all the work and you get to the final stages, and then one venture capital provider is picking his hand up and saying, I don't approve of this, I don't like this, and so that's not on, right? So you want, this is, I believe, and I've said this before, it augments your capital structure, right? And you want to bring it in it's in everybody's interest, right? It's in your current venture capital provider's interest to do it. It's in your as a founder, it's in your interest to do it. And it's certainly, obviously, as the venture lender, debt lender, you want to get this across the line. But if you don't make that a part of the process at the start, you often waste a lot of time, everyone's time. And as we know in startup world, time is money, right? So I would just encourage anybody who's thinking about this, get together, reach out to me. I'm happy to have a conversation. Reach out to my partner, Lesejo. We're always happy to chat, engage. But after talking to us, go straight to your founding team, speak to them, go to your venture capital providers, and speak to them, right? And tell them what you're trying to do early and upfront, and then sit down around a table in an ideal world and work it out between the two of you, right? Because that's how you get the deal across the line. It isn't by going on a long journey and then wasting everyone's time because somebody hasn't seen or understood the deal and understood it well enough to get it across the line. This can work. It should work. It's worked globally. The ecosystem needs it, but it needs a corporation, right? I think just maybe closing points on kind of scrutinizing terms and the like. I think just the biggest red flag from a founder perspective is, in my opinion, somebody who's kind of sitting there looking to where the term sheet's been structured in a way where there's a lot of subjectivity, right? You want it to be very clear. You want it to be very simple. You want to understand it from the start, and your whole team to understand it. It's critical that it's not subjective. It's just got to be very black and white, and less gray. There's material adverse changes where it's not defined. You don't know what it is. Often nobody knows what it is. Nobody ever gets sued on material adverse change. Nobody's ever actually instituted those things, but it sits in that term sheet, and you can't get an answer on what at what point that gets triggered. I would say, I think the point that maybe Nick made earlier, I think a good venture lender is behaving like an investor with downside protection. I think that's how you gotta think about this. Just another kind of capital structure with a bit of a different profile.
Yeah. And I also just wanted to add to that ultimately it is a relationship. So build a good relationship with your lender, right? So that if something should go wrong, they know you. They know you enough to trust you. And if someone trusts you, then they're not going to just, their knee-jerk reaction is not going to go to the debt covenants and go to the default clauses. It will be a relationship and a discussion. I've had ventures where, we had to renegotiate and get grace period after grace period because there was a good relationship going with it was a syndicated loan with 3 different banks, but the relationship with the lead bank especially helped us navigate very choppy waters at some point of that project, and it actually worked well for everyone. It's one of the good venture debt stories that I have, but it was because there was built in a really good relationship with the 3 lenders that we had. That's also really important.
And sorry, just to also say on relationships, it's not just the relationships of the portcos with the venture debt providers, but we've also seen some great deals done because of relationships between the VCs and the venture debt providers.
Exactly.
Where, venture debt providers really understand how this VC does their business, the types of businesses that they go after, and offer at least to give an easy hearing or an expedited process to portfolio companies. That in itself can be a nice draw for new companies to join you as a VC.
Yeah.
I also just wanted to say, in the spirit of what Digital Collective Africa is launching now on these like AI tools online, we as Vula also have a term sheet tool that we launched with the Innovative Finance Institute and FSD Africa that is actually here to help founders to be able to drop in a term sheet and get some guidance from an AI about what should you look for, where's a bit predatory, what you should worry about, and how it can be simplified. I'll drop that on the chat as well for a link for everybody so that you can share it with your portfolios. But again, like we need to find ways to make this simpler for everyone.
Yeah,
Thank
I
you.
see Alex in the chats, the other critical thing I think for founders to understand, like everything else, get a village around you. So get into a cohort. The reason why you get into like some of these accelerator programs is so that you have a community around you to walk the journey with you. And I just thought of it now because I saw Alex's name coming. There's so many ecosystem builders now that you find on LinkedIn. If you're an early stage startup, get yourself into a community of sorts so that you can access some of these networks. It will help you on your fundraising journey and you get the support that you need. And also you've got, trusted brains to go to if you're not sure of, whether you want to access debt or equity or which capital stacks. It's really important for you to be part of some community.
Thank you so much, Lou. And I agree with someone in the chat who said this discussion is going to need a part 2. So Dan, I hope you take note of that because I want to flag that we've come to the end of our allocated time, and I really still want us to hear from any founders in the room who would like to share their experience. Perhaps if Dan, you can help me check if there's anyone to unmute their mic and share the experience with us. But what I've really taken from this is the fact that nobody wants this debt to default, like Akash said. And what's also coming out clearly, especially for the founders, is to understand why, the why behind your need to get your hands on this debt, understand the terms of and conditions, what you're signing up for, have a community, the relationship. And most importantly, I also saw Alex typing about financial modeling and someone echoing that in the sense that it's very important to also understand your financial modeling and the seasonality of your business as well. So thank you, Dan. I don't know if we have any founder who'd like to share their experience. And then as we do that, we are also going to be taking a few questions from the audience. I think we have about 10 minutes before we wrap up.
Yeah. I don't know if there's a founder, but first of all, can we give a round of digital claps for the panel? That was really, 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 really good. Really, really great. I don't know if these questions, I think people can raise their hands, maybe react. I don't know if Alex, you have been active on the chat. Maybe you want to share a bit of something. I know you're in the space, so it would be good to hear also from you and maybe reactions, not even questions or reactions or things that you feel founders should take away. Yeah, can make it interactive now.
Thank you. Sorry, I do love a Zoom chat. I think I love the chat because often I'm the one on the screen staring at a blank wall of just random names. And so even though I don't have my camera on today,
That's
yeah, it
fine.
is really, really it's really fantastic. And I think what is, for so long, so many African founders almost think the only funding options of like angels and VC. And, it is just really fantastic to see this entire world of financing opening up and founders starting to have access to a variety of funding options. And I just actually did a refresher course with the Innovative Finance initiative, which is where I found the toolkit that Vula helped develop. And it's also just really exciting to see different case studies and different examples and really helping founders access the right kind of capital at the right time that's right for their business is so important. And I think, yeah, I don't know, we've also been running the Orange Corners Innovation Fund, which is actually almost an African and Middle East program. We work with CDI Capital to run the South African component. And yeah, we've done 2 components there. And lots of learning, lots of experience, lots of looking at how we can really help grow impactful business by using more concessionary debt, but also how we can also augment venture-backed businesses, which might need a little bit more working capital to gain more traction, to increase their valuation at the next round. And so yeah, and how do we also, as funders, educate ourselves about all these different instruments so that we also know how they work together and can advise founders on capital stacking and fundraising strategies in a holistic manner.
Thanks, Alex. Thanks so much for this reaction. Then if there's anyone else who has a question, you can raise your hand, come forth. Yeah, we have about 2 or 3 more minutes. I think it was so clear. There's no questions.
Yeah, it seems that there's no question. And perhaps to that extent, I can invite the panelists to share their closing remarks in no particular order. But even as they do that, I think what's we are taking away from this discussion, and as we wait for Dan to organize us for a part 2, is that for founders and businesses, it's important to really understand your needs, understand your business, and over and beyond that, good governance and discipline in terms of cash flow management, in terms of what you're spending your money on, is critical, because you could be doing everything right, and then certain market conditions like currency devaluation happen, and these come and completely destroy your OPEX. So discipline, discipline, and understanding of what instruments you're taking on. So in no particular order, and even as I give my thanks to the panelists, this has been a really, really great and insightful discussion. I do hope that some of the things that have been discussed here are already accessible in the toolkit, and so we'll continue to interact with it and learn more for the audience's sake. But yeah, your closing remarks. Or perhaps I can start with the lady in the room. Lou, give you the honor.
Oh my God. A lot has been covered and said, and I think for founders, it's always like information is power, empower yourself, do your own due diligence before signing any contracts. But yeah, debt is, it's a real option for you to scale your growth. So take it, but just make sure that you are well informed.
Yeah, from my side, I think thanks guys for bringing this together. It's great to try and get the message out there that this is not a noose around your neck. It's really, yeah, hopefully something that can help your business. And yeah, reach out if you have any questions. Ping me a question specifically on LinkedIn. Reach out on Newtown and my number. You can get hold of me wherever you can. And yeah, happy to try and answer any questions and hopefully get this part of the capital structure going in the African market. So thank you guys for putting this together.
Amazing. And I'll close off by saying that I think one thing that's clear is everybody in this ecosystem wants things to work. Like, okay, there are other people who are thinking too short term, fine. But we've got a critical mass of people, whether they're entrepreneurs or funders or ecosystem supporters or technology providers who want this to work. And we're all here to support each other. So the more new ideas there are, the more we actually try to get these off the ground, especially in an African context, the better. And we're very excited to be a part of this. And thank you for having us.
Thank you. And thank you to the Digital Collective Africa for putting together the toolkit and for having us. Back to you, Dan.
Thank you so much, Jacqueline. Thank you, Akash, Lou, Nick. It was really, really, really nice. Even myself, I learned a lot. Always learning. And no, thank you everyone for joining. As I said, the toolkit is available. What we are going to do is by tomorrow, you'll receive via email the recording of the session. It's going to be available on our YouTube channel _ Digital Collective Africa. You can find it on YouTube. We're going to share it. And yeah, and outside of that, part two, we will announce it on demand, on popular demand. So we make sure that you have a part two, and then we're gonna continue that discussion and check the new trends. But outside of that, have a good rest of the day for those who are in our time zone, and see you next time. Thank you, everyone. Bye
Cheers,
bye.
everyone.
Cheers,
Thank
cheers.
you.
Ciao,
Bye.
ciao. Bye.
Cheers. Thanks. Bye.
Bye.